Hi, I'm Abalore. The goal of every business is to profit, and economists assume that the success of every business is measured in terms of profits. So today's lesson is about profit measurement in two-dimensional ways: accounting profit and economic profit. Also, every business is established to achieve two motives, that is, primary motive and secondary motive. For example, privately owned businesses, their primary motive has always been to maximize shareholders' wealth through profit making, and secondary motive is to render quality services to its customers. On the contrary, government-owned businesses, especially those ones that have been commercialized, let's say the Lagos State Bus Rapid Transport (BRT), the primary motive is to render quality services. That means moving Lagosians and goods from one place to another easily. And the secondary motive is to make a profit. But governments will not always tell you this. So let's break down how profits can be measured both by the accountants and the economists. So profits. Profits is gotten by total revenue less total cost. So the accountants and the economists seem to be on the same page on what should constitute total revenue. So total revenue is gotten by the quantity of goods and services sold multiplied by the price at which they are sold. That will give you total revenue. But on the part of what should be the total cost. Because when we say cost in economics, we mean opportunity cost. So opportunity cost to the accountant is explicit cost, which is also called money cost. And the opportunity cost to the economist is both explicit and implicit cost. So let's start off with explicit cost. Explicit costs are costs incurred on resources introduced into the business from outside. A firm that needs to produce needs the ingredients of production or factors of production. All these resources, all these services are to be gotten from outside. So the costs incurred on all these resources are called explicit costs. So a good example of explicit costs are cost of land, which is the rent you have to pay for you to use the apartment for production. The cost of labor, which is the wages or salary you have to pay to the labor, skilled, semi-skilled, and unskilled labor. The cost of capital, that means the interest you have to pay for borrowing money in the financial institution. Cost of power, cost of fuel, cost of transportation, cost of advertisements, taxation costs, and all that constitutes explicit costs. So to get your accounting profit, since accountants only view cost as explicit cost, your accounting profit will be total revenue less explicit cost. So that's understood. Good. So to the economists view cost as both explicit and implicit cost. So in addition to the explicit cost, we have implicit costs. So implicit costs are imputed value of the entrepreneur's own resources and services into the business. Implicit costs, in other words, are what self-employed or self-owned resources could have earned in their next best alternative uses. And a good example, we have implicit wages, implicit rents, implicit interest. They all refer to the highest wages, highest rents, highest interest, which the owner of the business could have earned if he had loaned them out to other people for use, rather than using it for its own business. So, with the difference in accounting costs and economic costs, there will also be difference in their determination of profit. So economic profit is total revenue less the addition of explicit costs and implicit costs. So what you have after adding these two, you less it from your total revenue. That will give you economic profits. Or economic profits is accounting profits less cost of equity capital. So the basic difference between accounting profits and economic profits is the cost of equity capital. And this cost of equity capital simply means the cost of ownership. It means cost of equity means what the owner holds and use it for its own business. The opportunity cost of that is implicit cost. You had it with your explicit cost, and that will be deducted from your total revenue. So, like I said, the basic difference between the accounting profits and the economic profit is the cost of equity capital, what the owner contributes into the business. Also, the accounting profession considers or value cost of equity capital too, but they only value it as interest expenses. So accounting profession or accounting view cost of equity as only interest expenses. That means in a broad sense. Whereas the economist considers or view cost of equity as all opportunity costs. All opportunity costs. That's the way economists view cost of equity. That means in a broader sense. So, with all this explanation, let's try and see if we can solve this question with respect to all the explanations so far. So, in this question, we will have to determine the accounting profits and the economic profits. And we're given total revenue as $3,000, material costs, interest $200, labor costs, cost of land, implicit wages, implicit rent. So the total revenue for the accountants and the economists will be the same. So that's $3,000. And to get the accounting profits, we have all the explicit costs. That's explicit, interest expenses, explicit to the accounting profession. Explicit, that's labor cost, cost of land, explicit. So the addition of all this will give us the total explicit cost. So let's get our accounting profit. So accounting profit is, so we have accounting profits. Accounting profit equals, our total revenue is given as $3,000. So we have $3,000 less the total explicit cost, which is 500, that's 700, $2,000. So we have less $2,000, and that gives us $3,000 minus $2,000. We have $1,000. So our accounting profit is $1,000. So let's get our economic profits. Economic profits. So we can get the economic profits using either of these two formula here or equation here. So I'll be using the second one, and I will implore all of you to use this first one and put your answer in the comments below. Let's see if we're going to get the same answer. So economic profits equals accounting profits less cost of equity. So cost of equity, like we have, they have been broken down into implicit wages, rents, implicit interest. So in this question, we have the implicit wages, implicit rents, which the accounting profession does not include in its opportunity cost. So economic profits is the same total revenue, which is $3,000, less our cost of equity, which is given here as $600 each for both implicit wages and implicit rent. So we have, accounting profit is 1,000, which we've gotten here, and our cost of equity, as broken down there, we have $1,200. So that gives us negative $200. Negative $200. So you can see here that accounting profit is positive and economic profit is negative. Also, to determine the true picture of a business, we can ascertain that using either accounting profits or economic profits. But professionals prefer to use economic profit because it includes all opportunity costs. Meanwhile, the accounting profits do not include all opportunity costs, that is, only explicit costs. So, we want to look at the roles, the importance of economic profits when it is negative, zero, or positive. So when economic profit is negative, what that means is that resources have higher value in another use. So negative economic profit means that total revenue is less than total cost. That means the business owner is not earning enough for its total revenue to pay for all of its opportunity costs. And when a business is making negative economic profit, it means that resources should be moved from that sector to another sector where there are high positive economic profits. And negative economic profit is a characteristic of a firm in a perfectly competitive market in the short run, because a firm in a perfectly competitive market in the short run will either make supernormal profits or supernormal loss. So this is supernormal loss. It's the characteristics of a firm in a perfectly competitive market. So resources should be moved to other sectors where there are high economic profits. Resources, time, money, fund, everything should be taken away from that sector, creating negative economic profit, to a sector or marketplace creating positive economic profits. And what this means in its actual sense is that the business is making a supernormal loss. That means it's operating below the average variable cost. That means the business is having problem paying wages, salary, buying raw materials, and all that. So the firm is advised to leave that sector and move its resources fund to other marketplaces where there are high economic profits. Zero economic profits means that the firm breaks even. And when a firm breaks even, its total revenue is exactly equals to its total cost. And when economic profit is zero, accounting profit is usually positive. Like we did say, that accounting profits can either be equal to economic profit or greater than economic profit, because accounting profit does not include all opportunity cost, which is the cost of equity. So what we have here is that when economic profit is zero, the accounting profit we usually have is called normal profits. And here, the business is barely doing well. It's barely doing well. Although there is no incentives for the owner to move its resources to another marketplace or sector. So here, zero economic profit is a characteristic of a firm in a perfectly competitive market in the long run. Because a firm in a perfectly competitive market in the long run will make zero or normal profits. That's total revenue is exactly equals to cost. And lastly, positive economic profits means that the firm is earning enough for it to pay for all of its opportunity costs. And what that means is that resources from other sectors will be moved to that sector, creating a high positive economic profit. And what we mean by positive economic profit is that the resources in that sector will have or will not be taken to another sector. In fact, resources from other sector will be brought into that sector, creating that positive economic profit. And it is a positive signal for investors to bring their money fund, time, and everything into that sector, creating the positive economic profits. And positive economic profits means that the firm is making a supernormal profit. Supernormal profits means that the firm is making a high positive economic profit. And supernormal profits or high positive economic profits is a characteristic of a monopolist. Monopolist means a single seller having many buyers. So, should in that market there is principle of free entry and exit, this positive economic will be reduced to zero or virtually negative in the long run. And what we mean by that is if there is principle of free entry or free exit, firms can come in, and when they come in into that sector creating the positive economic profit, supply will increase. And when supply increases, that will lead to surplus. And the consequence or the economic result of surplus is that price will reduce. And when price reduces, the positive economic profits will be virtually zero or negative. So these are the roles, these are the importance of economic profits when we have it called negative, zero, or positive. So negative could be a characteristic of a firm in a perfectly competitive market. That's in the short run, because a firm in a perfectly competitive market would make a supernormal loss in the short run, but in the long run will make normal or zero profits. However, for positive economic profit, it is a characteristic of a monopolist, a single firm having many buyers, just like we have Dangote PLC in the cement industry, being the only one supplying us the cement in Nigeria. So it's really making a supernormal profit. And that will be in the short run and in the long run. So that's with respect to today's episode. I want to believe you all have learned one or two things with respect to what we've talked about so far. Should you want to be the first to get our newest video, you can always click the notification bell. And each time we put a video out, that will come straight directly to your smartphones, to your laptops, to your desktops. And do not forget to like and share our videos to friends and relatives whom this video might be of great help. And I want to say a big thanks for everyone for having stuck with me this far. I want to say I'll see you all in my subsequent video. Do have a good one. Bye-bye.